Hey traders, welcome to this video. Happy Thursday morning, evening, afternoon, wherever you are. Might be a different date by the time you watch this. Don't forget to get my free training / join my live trading room where I go over all positions with my co-mentor every single day in our private academy. So the dollar yen, an interesting subject, one of which I'm going to cover while the markets are slightly slow. I mean, the only thing you've really got moving at this point is those yen pairs. And there's good reason, particularly the dollar yen. What you can see at the moment is there's slight strength for the dollar, and you've got weakness for the yen at the moment. A lot of the rhetoric regarding the Japanese yen comes from the Bank of Japan, and they're teetering on the idea currently of changing their stance as they've had negative rates, which is largely different from practically any other major economy. And they've felt the force of those negative rates because what it's done is it's weakened the Japanese yen so much, which is why you have seen this. Okay, the reason for this and how you could have preempted this was simply by the fact that the interest rates were so low, you had so much dollar strength, and you've risen and risen and risen. Now, on your recent US jobs data, it looks like the amount of time until the US or the Fed cuts is going to extend, and that's really because when you've got higher wages, more people employed, it helps inflation not go down because people spend more money. In short, so you've got the central bank in the US basically supporting the US dollar at the moment, or with what they're saying. And you've got the Japanese yen teetering around on the idea of changing their rates. But obviously, that's not powering enough as sentiment for a change in direction. Also, remember as well, the Japanese yen can be seen as a safe haven asset. And again, at this point, people aren't prepared to go into safe haven assets because there's a risk-on feeling in the market. In other words, people are taking risks. Like you can see on US indexes, for example, where you've got these sky-high prices and this overconfidence from traders, which I'll cover in another video on the S&P. But at this current point, you've got your macro sentiment, if you like, there, which I've just discussed. Really, from a tech perspective, which is largely where I specialize, you can see this high here, which I've just labeled with the eclipse, and this high here. Now, what's happening is, and this is something you'll see a lot in markets and FX markets alike, you've got this really strong green candle pushing straight into these highs. Now, you've already gone above, more or less, this one, okay? And for me personally, when you've got something so strong, such a harsh body candle, so it's very full, it's clearly very forceful, you could see the momentum with this is to the upside. And you've got also the fact that you fell to this early minor price action and you flew straight up. It doesn't particularly matter that your stock oscillator, RSI, whatever you're using is overbought. Really, the point here is that you're slamming straight back into these highs. So clearly the momentum is with the US dollar and not with the yen because of the yen weakness you're seeing, especially across the board. If you swap onto lower time frames, again, you can see that very clearly. Okay, you can see that you're just coming straight into these highs, but they're not doing an awful lot. They're not shaping up like they did last time. So with all of that in mind, that tech bias and the momentum of this FX pair, it wouldn't surprise me at all if you end up above this by the end of the day, going into those areas of higher price action. Okay, so I would say this area I'm labeling now, coming in line with all these previous price action levels, the areas where you've fallen previously, is going to give you ideal areas for entry. And that's going to come in line with a high fib scale, again, reflecting that strong bias, about 0.786, going nearer 0.886. Okay, so you could, if you're absolutely risk averse, hold off till 150 perhaps. If you're slightly less risk averse, you could enter a bit earlier. But this is going to be wholly dictated by a larger change in market sentiment. I think that's where you're going. I think you're starting to run out on all of these market scenarios like indexes, things like that, equities, futures markets. So if you get up to this point, you could have a further entry short if you don't have one already, but that's an ideal place to space out and get short, in my opinion. Any falls, I would need them drastically lower to keep price action on the downside, which is probably going to come around there. So those are my long and short levels and my macro analysis. I hope that helps. See you in the next one.